We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. The goal of this series is to help you better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. The Institute is a professional association, advanced education provider, and standards body for financial advisors, investment consultants, financial planners, and wealth managers who embrace excellence and ethics. Through our events, continuing education courses, and acclaimed certifications, which include the Certified Investment Management Analyst, Certified Private Wealth Advisor, and Retirement Management Advisor certifications, we deliver Ivy League and practical education for investment and wealth professionals. Hi, I'm your host, Bob Powell. I serve as the Institute's editor of the Retirement Management Journal, as well as the editor of the Street's Retirement Daily. Today, we are talking about option strategies and a new course offered by the Institute. Our guest is Marc Odo, Client Portfolio Manager from Swan Global Investments. So welcome to the podcast, Marc. So let's start first by having you tell us a bit about yourself and your background.
Sure, be happy to. So the name's Marc Odo. I'm the Client Portfolio Manager at Swan Global Investments. I've been with the firm for almost 5 years come January 1st. And Swan Global Investments is a hedged equity shop that uses options for both hedging and income purposes, and they've been at it for 22 years now.
So, and I take it so obviously we're here to talk about the course that you're launching. And so let's start by having you talk a little bit about what are option strategies all about.
Sure. So with IWI, Swan Global Investments has developed a series of modules, video recordings that we're calling All Options on the Table. And the objective here is to get people more familiar and more comfortable with the use of options. Obviously, we're big proponents of the use of options. We've been doing it for over 2 decades now. And even though you've seen the space grow quite a bit, I still believe there's a fair amount of apprehension or discomfort. People are still a little bit skittish about options, and we're trying to help them with that, help them understand how options can be used, what the risks are, what the advantages are, how they can help in a portfolio, and just increase the comfort level overall in options.
Right. Okay. So I should mention that the course is being delivered through the Institute's learning platform, and that the course will launch in December 2019 and be available to learners throughout their Institute dashboard. So, and also that the course represents 4 Institute hours of CE, and that CFP CE is pending. Pending the approval of a quiz. So talk a little bit more, Marc, if you would, about why you did develop this course, if you don't mind.
Sure. Well, when it comes to the financial advisors out there, I don't think what I'm going to say here is really a revelation to anyone. I think it's a problem that everyone in the financial industry faces. There's several challenges out there that have all cropped up since the global financial crisis that people are struggling to find solutions for. And we think that options can address all 3 of these roles. The first one is, the problem of another major market sell-off. Now, granted, it's been 10 years since the global financial crisis. We haven't seen a true bear market since 2008, 2009. But that being said, we have seen the 2 biggest bear markets happen since World War II, have been in this, since the start of the new millennium. So people are looking for solutions on how to address that bear market risk. Another outcome of the global financial crisis is income, right? I mean, the yields and income and interest rates have been suppressed and kept so low for so long, it's really difficult for people to generate income out of their portfolio. Again, options can play a role. And then the third and final thing, which I think a lot of people are struggling with here in this current state of the market, is trying to generate alpha. I mean, this whole active versus passive thing has been raging for decades now, but it's only been in the past 10 years or so that the tide has really tipped towards passive strategies. So again, we believe options can fulfill a role of providing alpha there. So that's really what we're trying to accomplish with different ways options can be used. And this 10-part course talks about all the various aspects here. There's 10 different videos. Each video is between 10 to 25 minutes long each. We start off simple, with the very basics. The first one is just options 101. What is a call? What is a put? Why would someone write a call? Why would someone buy a put? So on and so forth. But then we climb the ladder. I will say that the focus here is more on the implementation of strategies. It's not so much here are specific trades that you might do yourself. It's more about focusing on the many 40 Act products, mutual funds, and ETFs out there that are doing this for you. So really, if I guess I to kind of surmise it, the course here is more kind of understanding the build model, understanding the buy model rather than the build model. It's if you are going out there and trying to hire option strategies, what should you be looking for? What's your due diligence? What understandings should you have of it, rather than you doing the actual buys and trades yourself.
Hmm. So when you think about the course and who it's geared toward, you mentioned toward people who want to either hone their craft or just expand their skills and competencies. Could you talk a little bit about that, who it's geared toward?
Sure. Well, I mean, I think there are a lot of people who recognize that the options can provide these roles, either hedging purposes or income purposes or alpha purposes. But there's so many different choices out there now. I mean, the whole option space has been exploding. If you look at different 40 Act products, mutual funds, and ETFs, back at 20 years ago, there were scarcely any players in this space. But these days, we have close to 200 products to choose from and 20 billion AUM. Now, that's a good thing, right? We've seen lots of growth in this space, but it's still an evolving space. I mean, only a couple years ago, Morningstar didn't even have a category that was dedicated to options. You would find option-based strategies kind of tucked into maybe market-neutral strategies. You'd find some over here in long-short. So one of the improvements that we've seen is that we do now have an options-based category. But that being said, a lot of people kind of approach this thing with not really either the skill set or the understanding to pick apart, those 200 managers and understand what these guys are trying to do and what their objectives are. One of the comments I like to make is it's a good thing that we have this category in Morningstar called options based right now. But what is an option, right? An option is just a security. And that's like if Morningstar were to tell you, oh, it's a stock fund. Right. That doesn't really help you if Morningstar tells you it's a stock fund, because a stock is just a security. Now, your question, if you're going to use this fund, is well, what kind of stock? Is it large cap? Is it small cap? Is it value? Is it growth? Is it U.S.? Is it international? There's a lot more deep dive you can do into this category to really understand what the objectives are, what the risks are, what you should be aware of. And that's really what we're trying to provide here when it comes to approaching the option strategies. Again, there's 200 odd funds out there. This is only growing. It's only going to get bigger. If you're looking at these guys, what further analysis and understanding do you need to do to really understand, okay, this guy is meant to hedge a portfolio, whereas this guy over here is going to be more of a high octane alpha type strategy.
Mm-hmm. So we've talked a little bit about why this course and this topic is relevant in the current economic climate. Did you want to elaborate on that at all? Did we miss anything about why it's so relevant?
Yeah, I mean, I think I certainly talk a little bit more detail there. I mean, when it comes to hedging purposes, the risk is always there. I mean, in the .com crisis, the markets lost about 45% over 3 years, and it took another 3.5 years for the markets to eventually recover. And that was a cataclysmic event. I mean, that really was harmful for a lot of people's portfolios. It was only a few short years before we had the biggest calamity to hit the market since since the Great Recession. That was, of course, the global financial crisis. The market lost over 50% of its value in about 18 months. And all the diversifiers, the things that people put their money into, call it, emerging markets or small cap stocks, all the things that were supposed to diversify your portfolio to mitigate risk, didn't really help. Kind of the joke there is that, when everything's down, the only thing's up is correlations, and that kind of blows up the traditional mean variance optimization MPT type model. So I think people are looking for other solutions or solutions to complement the traditional role of diversification. And again, options can be used for hedging strategies. That's one of their primary purposes. But there's other things too. I mean, we're talking about the fact that the Fed and all the central banks in the world have kept rates so low for so long that we're scraping the bottom of the barrel there when it comes to yields, that people are looking for all sorts of other ways to generate income. And certainly people are looking at REITs or non-traded REITs or all sorts of different ways to generate income. But options play a role. Options can be used to generate income too. And again, that's kind of what this course goes into is saying like, okay, well, let's subdivide these strategies and separate them. Really try to understand what the drivers of returns are with these types of strategies, how they're built, what the risks are. One of my core fundamental philosophies when having been in this industry for, I don't know, 25 years now, is understand the bets you make, right? If you're going to invest in something, if you're going to bet on something, understand what you're getting into. And this course is meant to help people understand all the things they need to know before they make that choice to make that decision to invest in an options-based strategy.
Right. So let me just ask you to address. You mentioned funds that use option strategies, but the course is also designed to help advisors use option-based strategies to expand their clients' portfolio, independent of funds that use option strategies. Is that correct?
True. Yeah. I mean, lots of the stuff is crossover. There are certain core fundamentals about understanding what the risks are to either buying a call or writing a call. Understanding what the risks are if you own a put or write a put. And we do climb the ladder a little bit. We get a little bit more sophisticated. People when it comes to the options always talk about the Greeks, right? Well, what is the Greeks? I mean, essentially, the Greeks are the risk factors that drive the price of an option. One analogy I like to use sometimes, it's like when we talk about stocks, we talk about, we've got the volatility, we got the momentum factor, we might have the value factor, we might have the dividend factor. Those are all factors that drive the price of a stock. Well, when it comes to options, there's a set of factors, but it's different. It's going to be things like, theta, vega, gamma, delta, these things that might sound intimidating initially, but we go through these things and kind of explain them. And there's lots of, pictures, lots of illustrations, and lots of analogies that I think work well to help kind of describe, what these different things mean. And I'll give you an example if you want to hear one. I mean, one of the things that drives the price of an option is the time to expiration. It's known as theta, or time decay, because every option eventually expires, right? It might expire a week from now, a month from now, a quarter from now, but eventually you get down to those double zeros and it becomes worthless. So if your option is in the money, if it's worth something, you want that clock to expire rather quickly, right? However, if you have that option and if you own that option and it's currently not worth anything, well, the more time on the clock, the better. So the analogy is kind of like it's like a football game, right? Say it's the 2-minute warning, your team is up by 7 or down by 7. Well, if you're up, if you're in the money, you want that game to be over real quick, right? Because boom, it's going to be worth something. The more time on the clock, that's actually worse for you. Conversely, if you're down by 7, it's a 2-minute warning. Time is your enemy there. You need something to happen real quickly in that little space. Otherwise, you're going to be tagged with the loss there. So, those are the types of kind of real world analogies and stories I tried to pepper throughout this thing to help make this a little bit more relatable.
So since we started talking about one of the modules, as I'm looking at the titles to some of them, they're quite intriguing. Module 3 is avoiding the big blow up, and Module 6, I think, is volatility in the VIX. And certainly there's a lot of interest in, I think, the VIX. But talk a little bit about avoiding the big blow up and what our learners will learn in that Module 3.
Avoiding the big blow up. Yeah, that's been one of the more popular ones. I'm not going to deny that, one of the things that has been disadvantageous to options and the adoption of options has been the fact that there have been some well-publicized blowups. I mean, it seems like maybe once a year, once every 6 months, every so often, you'll pick up the Wall Street Journal or log into MSNBC and you'll read about some strategy that blew up and lost 50, 70, 80% of its assets, had to be shut down. And everyone is like, oh my gosh, options are toxic. They're ticking time bombs, and they're, never invest in option strategies. And that's, I think, casting the baby out with the bathwater there. In my opinion, options are just a tool. They're just a way to invest. And it's really how options are used and not if options are used. At the risk of kind of giving away the the main thrust of the of Module 3 there, essentially what we do is we talk about there's 3 smoking guns when it comes to option strategies that have really been responsible for these different blowups. And those 3 things are excessive leverage, poor liquidity, and lack of adequate risk controls. If you look, if you perform autopsies on some of those different strategies that blown up, typically it's not just one, but it's all 3 of those things. It's excessive leverage, poor liquidity, and or poor risk controls that have caused problems with those kinds of blowups. So, it's meant to help people learn from the mistakes of others. Certainly, yes, we don't want anyone to be invested in something that's going to blow up. So, be aware of what's going on underneath the hood before you invest in these things.
And then in module 6, you talk about volatility and the VIX. Obviously, so much interest in the VIX and so much interest in volatility these days. Care to elaborate a little bit on what learners will learn there?
Yeah, I think it's a great question. I think VIX is something that's often misunderstood. I mean, when you hear the word VIX thrown around quite a bit, what people always say it's the fear gauge, right? They always say, "Well, the VIX is the fear gauge," but that's a very mushy definition of what the VIX actually is. And again, what we're trying to do is clarify exactly what it is the VIX is measuring. And essentially, what the VIX measures is it's an index of option prices. So we take a look at the various calls and puts out there that go out very, very short time period, and we just see how much people are paying for them. And you can kind of infer, therefore, like how much people think the market's going to go up or down by just how much they're paying for those options. So yes, I guess the kind of the secondary or tertiary definition could be the fear gauge, but really what you're looking at is the supply and demand conditions for options there. And yeah, I mean, certainly within the last couple of years, it's been a wild ride there in volatility. In 2017, it was at historic lows, and the realized volatility, what the market actually did was even lower than what was anticipated. Throughout 2018, we had kind of a Jekyll and Hyde type market where people were very docile in the summer months. From April to August, September, things are very quiet, just like 17. But you had these big volatility spikes where all of a sudden people were hitting the panic button and running around trying to hedge their portfolios. So, this year's been a little bit different. We've seen some choppiness, but yeah, I mean, it's getting back to this idea of what are we actually measuring here, and it's the supply and demand conditions of options is essentially what the VIX tells you.
So there's been a great deal of discussion that this market may be closer to the top, and that folks are now worried about a bear market or a downturn in the market. So talk a little bit about how option strategies can prepare investors or advisors for a potential bear market or a bear market.
Sure. I mean, I think that is one of the primary roles that options can play within the portfolio is the that hedging. Owning a put option gives you the right to force someone else to pay you for that asset, regardless of what the market price is. So, today the market's trading around 3,100 or so. If we can force someone else to pay us 3,100 for it, if the market collapses down to 26 or 22 or whatever, that means we'd be sitting pretty. Now, of course, that's if the market continues up, that's going to be a drag on your portfolio. So you have to kind of be smart about it. And there's different ways that all these various options strategies help to mitigate or minimize the drag in an up market. Sometimes people market time their hedging, where they'll be either risk on or risk off. And if you're good at that, then that's great. Sometimes people say, well, I'm going to hedge my portfolio or protect my portfolio using put options, but I'm not going to necessarily hedge at current market levels. I might put that protection in at 500 points below the market. So essentially, the insurance is cheaper, but it's that first tranche of losses is then on the investor. So there's lots of different ways, and again, these are all the things we talk about. Different ways that you could potentially mitigate the cost of remaining protected. Should that bear market happen. Now, of course, for the last 11 years, you didn't really need to protect. I mean, the best thing you could have done is put all your money in the S&P 500 for the last 10 years and just let it ride. But I don't think a lot of people are thinking the next 10 years will be identical to the previous 10.
Right. So you mentioned hedging and comparing it to insurance. Obviously, much of what advisors have to do is communicate what strategy they're using and why. So how best for advisors to present or explain hedging to their clients?
Yeah, and that's actually the topic of our 10th module is trying to explain all this stuff to your clients. I mean, the first 9 modules, kind of get maybe a little bit deep into the weeds when it talks about all this stuff, but the very last module is bringing it back to plain English definitions and descriptions so you can talk to clients about this. One analogy we've always liked that people are familiar with is this concept of insurance. Why do people buy insurance? They buy insurance to protect against catastrophic losses. Now, you're probably not going to, you probably shouldn't buy insurance for protecting if your iPhone earbuds go out on you because it's a small cost, right? But certainly protecting your car, your boat, your house, these things that if something were to go wrong, it would make sense to give up some cash to protect that. So yeah, certainly if we knew that nothing would ever go wrong, you'd have a lot more walking around money in your pockets if you never had to pay for insurance. But most people are willing to give up some of that cash flow just to have some degree of protection, some degree of safety for the things that are really important there. Now, it's not a perfect analogy. It's a good analogy, but people need to keep in mind that an option is not insurance, and that the compliance department's FINRA is going to be sensitive to those things. But as far as an analogy, I think it's a legitimate analogy.
Certainly, as a principle of risk management, hedging and insuring is something that people would understand, at least from a layperson's point of view.
Yep.
So obviously, there's been a groundswell of interest in passive investing of late. And how does an option strategy fit into this trend?
Yeah, and that's something else. I think this passive versus active argument's been going on for 50 years now. People have been saying which is better, which is has advantages, and it's really in the last 10 years or so that you've really seen the pendulum swing to passive, where people like costs are the only thing that matters. Just throw all your money at Vanguard or a BlackRock ETF, and that's all you need to worry about. But I think the one thing that's unaddressed in that whole argument is the fact that the markets have been up 400% since the bottom, right? It's great if you catch 100% of the up market when the market's up, but when the market goes down, well, you're going to catch all of that downside too. So people are looking, I think, for alpha opportunities. And yeah, if you look at large cap markets, it's very, very difficult to squeeze any incremental return out of the S&P 500. But that being said, some of these option strategies, some of these alpha strategies or trading strategies don't necessarily depend on the conditions of the market. They can be driven by volatility conditions. They can be driven by, different short-term type things, things that are not necessarily purely directional on the S&P 500. So some of those strategies are fulfilling that role of being kind of the sizzle to the steak, kind of a satellite to the core of a pure beta type strategy.
Right. So we've talked about several of the modules, and we've also talked about perhaps the problem of learning the language of options as a hurdle, perhaps that this course will address. One of the modules is titled Synthetics, and I'm curious if you could tell us a little bit about what students will learn in that particular module.
Yeah, synthetics is kind of at the end of the course because it's a more advanced one, and it kind of brings together some of the various concepts here. One of the things that's really interesting about options is that there's many different ways to skin a cat. If you were to say, like, well, my objective is to have maybe this type of market exposure. If the market goes up somewhere between 5 and 10%, but not more than that, then how do I capture that? Well, one of the things that's great about options is you can design very specific risk return profiles, but moreover, you could do it using different methods, different ways. So the most obvious way of trying to capture that 5 to 10 upswing in the market would be to buy a call and then also maybe sell a call that's further out of the money there. But there's other ways that you can kind of capture that by trading puts, writing puts, so on and so forth. It's kind of like an algebra equation where as long as you have 2 of the 3 variables, you should be able to solve for the third, and there's many different solutions to get you there. So it is a little bit more of an advanced topic. It's a little bit more arcane. That's why it's towards the back. But it is really pretty interesting when you think about all the various ways you can mix and match these puzzle pieces.
All right. So this may not be directly pertinent to options and the course, but there's been some talk in the industry that 60-40 is dead. What are your thoughts on that?
Yeah, this kind of gets back again to this everything that we've seen in the post-global financial crisis world is, for the last 40 years almost, the 60-40 has been a great investment. Anyone with a simple combination of the S&P 500 and call it the Lehman aggregate is probably doing pretty well. If the bond portion of that 60-40 portfolio is giving you 7.75%, if that's the safe portion, that's pretty good, right? It's hard to go wrong if that's the safe portion of your portfolio. But these days, I'm not sure if anyone is really predicting that bonds are going to give you almost 8% a year going forward here. Traditionally, bonds have performed two roles in the portfolio. They've been there for capital preservation purposes, and they've given you income. You've been able to have your cake and eat it through, since the late 80s when the yields fell from 15% down to these historic lows. The problem is looking forward here. I mean, what realistically can we expect from bonds when yields are less than 2%? Is going to be anything close to that? Are you going to have that income or capital preservation, or are you going to be stuck with neither? So faced with that, it kind of gets back to those those three things we talked about at the outset, where people are looking for something other than bonds to hedge their portfolio, something other than bonds to be that capital preservation role, and something other than bonds to provide income. And again, options are a potential solution for that. It might not be the only solution, but it's certainly something that people are exploring. And that's why I think we've seen, this asset class grow from almost nothing to 20 billion AUM in a short period of time here.
Right. So anything else advisors should know? What else do you see for the road ahead? Anything that we haven't touched on that you think is important to touch on?
Well, I think, I certainly hope that this course helps people. I hope that, they, after watching this, they come away with a better understanding and appreciation. It kind of gets back to one of the things I said previously about always understand the bets you make. So, I want people to, check out this course and then feel comfortable when they make their decisions to invest in option-based strategies, or trade options themselves. Now, I do think that this space is only going to grow; it's only going to get bigger. But I also think that it's inevitable that there's going to be a couple of missteps or bad apples out there that are going to blow up in the future, and those are the ones that you want to be aware of ahead of time by doing your due diligence, doing your homework. I think one of the things I said in one of my previous talks about this was that these days, it's very hard for the analyst to look at a strategy, a mutual fund, or an ETF or whatever, and make a recommendation that really, is impactful, that really makes a difference. But this space is one where the due diligence really does pay off. I mean, this is the kind of space where doing your homework and really understanding all the various risk factors is well worth the time spent. And I hope that my course, assists with that. I should probably give a shout out to some other resources out there. I mean, obviously we're promoting the IWI course here, but we respect what the guys like at CBOE do. There's the Option Industry Council, the OIC. They do some really good work, all with this common goal of getting people better versed at options and understanding what they can do to help you out.
So I guess one of the last questions is, where can advisors find this course and how do they enroll in it?
Yeah, so it's on the website. It's available on the IWI website. Visit www.investmentsandwealth.org /online catalog to enroll there, and that's where the information is.
Great. Marc, it was a pleasure chatting with you about the course. I can't wait to enroll in it myself, and with hope you'll come back on and talk about other things that Swan is involved with.
Yeah, I'd be happy to do so.
Great. Thanks so much.
Thank you.
My guest has been Marc Odo from Swan Global Investments. Thank you for listening to our Exceptional Advisor podcast. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org /podcast to get the latest episodes of our Exceptional Advisor podcast series.